Hello, my name is Greg Hebner. I'm going to share an advanced topic about how to quickly model increased rents in apartment communities using the average monthly rent we intend to collect over a 12-month period. This will be a more simplistic method that should enable you to complete within just a few minutes or even less to quickly see how your financial model improves. So I've got our initial analysis up here. The average rent for all the units, in this case, I think it's about 62 units, 1 and 2 bedrooms in this analysis. The average monthly rent is about $712 a month. And just taking a standard 3% rent increase, we're up to 733, and then in year 3 up to 755. You can see some of the other vacancy and bad debt, loss to lease projections there. That gives us roughly in year 3 about 550,000 in total net income. And what we want to do is change that 550,000 into 595,000 in net income in year 3. And what we do that, we can just increase the rent, the average monthly rent we intend to collect. So this is taking about $100 a month rent increase and modeling that increase over 3 calendar year or 3 years of ownership. And I'll go through how we actually go do that inside of our analysis software. So just really quickly, I consider this more art than science. There definitely could be a scientific approach to it by the lease end date, and that's a very sophisticated financial model whereby you go unit by unit and say this lease is going to be up in December. We're going to maybe do unit improvements or turnover in January. Hope to lease it by March 1st. So you've got two months of vacancy, or 1/6 of the year of vacancy for that apartment. So you've got to build that into your financial model. So you might get $100 more in rent come March. However, you haven't received 1,450 in rent for January and February. So you've got to be able to compensate that from a very sophisticated financial model. So what I intend to do from a simple math perspective is just model that increased rent using the average monthly rent initially to see whether or not our analysis kind of plays out, and we can actually move forward into negotiating a letter of intent or a contract with the owner. So here we are in our analysis software. There's a lot of information here on the screen, but I'm just going to be focused on this income area at the top here. Is really all I want to be focused on right now. And so we're at $712 a month rent currently, and we want to get to we want to get to about $825 a month in year 3. So I'm just going to type in, override this formula in this cell in our analyzer software, and put in $825. Okay, you can see how all the numbers change. That gets us to our $595 in net income, and that's happy days. I know I'm going to be increasing the rent a little bit in year 1, but I'm not going to go overboard. There's a lot of things I need to do in terms of just getting familiar with the property, getting familiar with the tenants, and I can't just go through day 1 and take over the leases and say you were paying X last month, your lease doesn't renew for another 6 months, but you're going to get a rent increase. That's not allowed basically by law. So I'm going to financially model. I think it was about a so we've got $735 for the average monthly rent in year 1. And then I'm just going to kind of split that difference between year 1 and year 2, and actually just go a little bit below, splitting the difference at $775, just because to get a little bit more feel for the property and to be a little bit more conservative in nature. I'm just going to highlight these cells real quickly here to show that I've changed them. Nothing sophisticated there, but you can see how our financial model has improved there. So nothing really sophisticated. I've got comps for my rent. I've talked with a property manager. I can verify the evidence that today, currently, the rents can be $100 more a month. But again, I'm not going to just increase the rents $100 a month. I'm going to be conservative in my approach, in my financial model. I could definitely ask for it in reality, but in my financial model, I'm going to space out that increase over a 3-year time period. So what does that actually do to our investor returns? Again, there's a lot of information on this screen, but I'll take you to two numbers primarily. One is if we sell this property with a 5-year projected sale, the investors would actually have to pay $7,000 in order to complete that sale. That's not a conversation you want to have with your investors. Their overall return would be around 40%, just under. But the positive, it does have good cash-on-cash return. 8% isn't anything to sneeze at. But we don't want to have the, hey, you need to come to the table with $7,000 in order to sell this thing, conversation with our investors. So just by modeling that projected rent increase, what does our investor returns evolve into? And that is total returns of about 88%, with a nice distribution of $330,000 upon a year 5 projected close or sale of the property. So now we can, they can get cash. We can do a 1031 exchange. There's lots of things we can do with that. But basically, this is a much better conversation to have with your investors. You can see the more sophisticated analysis metrics there, and an improved cash-on-cash return, up from 8% to 10.5%. So this is much more a conversation you want to have with your investors. And this is just demonstrating, and all I did was change the monthly rent. We identified a property where the rents were lower than they should have been at market, based on the quality of the units. We didn't go through and improve the units or anything like that. All we did was say we took advantage of an opportunity where the rents were below market, is all we did in this scenario. So real quickly, this is just a simple rent increase. As I was saying, we took advantage of a situation where the rents were under market. We found that situation, we negotiated it, and we were able to take advantage of the situation that we uncovered. And we added significant value, not only to our investors, but also to the property, and hopefully to the community, which is also very important as we are good stewards of our communities in which we invest. And lastly, just make sure that you verify your rental comps. You can put whatever numbers into that spreadsheet, but again, you don't want to have a conversation with your investors where, hey, you projected X, we're only getting half of X. Why? That's not a conversation you want to be in with your investors. So being able to have verify those rent comps, being conservative in your financial modeling, it definitely something very beneficial that you can carry forward, and it should lead to positive outcomes. Thank you. Hopefully you like this. If you have any comments, please leave them in the comments below, or reach out if you'd like any additional help. Thanks. Have a great day.